Passive Pockets is presented by Equity Trust. Before we get into this special deal review episode, here are the required disclaimers that remind you that all investments carry risk and that none of this commentary is intended to be financial, tax, or legal advice. This program is intended to display how experienced LPs analyze a deal and question a sponsor. Now let's get to it.
Hello, passive investors. Welcome to Passive Pockets presented by Equity Trust. I'm your host, Paul Shannon. Today, we're bringing you another installment of our exclusive deal review series. Our goal is to equip you with the tools and insights you need to confidently step into passive real estate investing as a limited partner. Reviewing real deals and asking critical questions is one of the best ways to sharpen your investing skills. Today's guest is Andy Weiner from Rockstep Capital, who's here to present their Hometown America Fund 1. Joining me for the LP panel are expert LP investors Adam Cranmer and Pascal Wagner to help break down everything you need to know about this deal. Here's a quick rundown of today's format. Andy will kick things off with a 10-minute overview of their deal. After that, Adam, Pascal, and I will have about 15 minutes to ask follow-up questions. Then Andy will sign off and the LP panel will dive into our own discussion and analysis of the deal. As always, passive investing still requires active evaluation. Our goal is to give you a peek behind the curtain on how experienced LPs think about these opportunities. Let's dive in.
Thank you, everyone. I want to share the blueprint for shopping centers. So let's start first with Rockstep Capital. We are a privately held, vertically integrated real estate investment firm. We're based in Houston, focusing on shopping centers in what we call hometown markets across the country. I'll go into that in a second. Why do we like retail? So first, when we talk about retail, we're talking about three subsectors of retail: the enclosed malls, which generally have a couple of anchors, open air centers over generally 200,000 square feet without a grocery store. Those are called power centers. Neighborhood centers, sometimes they have grocery stores, generally under 150,000 square feet. We like retail because there's two things that are favorable. One, the Amazon effect really, combined with COVID, killed weak retailers, and those that are left are expanding. And as a result of the Amazon effect, they're kind of maturing. The quality retailers have been able to protect market share against Amazon, and they're growing into an inventory of shopping centers that is not growing. So very favorable supply and demand dynamics. So you can see here that the number of shopping center square footage is almost, new shopping center square footage is almost at historical lows. Retailers are growing. They've got great balance sheets competing against Amazon into an inventory that is not growing. So you can see that over the last several years that basically vacancy across all subsectors has gone down. Closing of stores, as you can see, is at historical lows. A big tick up in COVID. So stores are not closing, and a lot of, we'll call it 20, 30 retailers are growing by 50, 100, 150 stores per year. The second thing besides supply demand dynamics that's favorable about retail is that we're pretty much the only sector in commercial real estate that has yield. And what we have is positive leverage. Positive leverage is your yield or cap rate is higher than your interest rate. So we're buying a grocery anchor deal now at a 9 cap, borrowing it at a 7% interest rate. Power centers are 9 to 9.5 cap, borrowing at 6.5 to 7. Enclosed malls, we're buying at 15 cap, borrowing at 7.5. So again, tremendous cash flow, and your cap rate exceeds your interest rate, different than multifamily, oftentimes where it's valued at 5, 5.5 cap. You got to borrow at 6. You have negative leverage. Why do we like shopping malls? Basically, great real estate. There's $50 billion of insolvent debt underlying the malls, and you can buy them typically at mid-teens cap rates, often at land value. And with malls, you can either harvest the cash, or you can sell off the periphery in an arbitrage strategy, or you can shrink the amount of retail and bring in alternative uses, medical office, multifamily, other types of resi, industrial, hospitality, etc. Why do we like neighborhood centers, power centers? Basically, you're buying them at 50, 60, 70% of replacement costs, and strong retailers are growing into that type of product. And so you've got very favorable supply and demand dynamics. So what are the keys to successfully investing in retail? One, you've got to do base case underwriting. Basically no good stuff's going to happen. You want to be able to hit a mid-teens IRRs as if nothing good's going to happen, but you know that you might be able to replace pennies with TJ Maxx at 5 times the rent, or get property taxes reduced, or get 300 units of multifamily approved by the municipality, but you never underwrite that. So you do base case, you work on taking advantage of your opportunities post-closing, and that's how you underwrite. Number 2, you never overpay. You got to buy it right. We've been second on 5 deals in a row. We weren't going to stretch. We won't stretch to overpay. And then once you buy the property, you really got to focus on executing the business plan in a very disciplined manner. Why do we like hometowns? Hometowns are markets typically under $1 million, but they can be as small as 100,000. There's something really different about hometowns. The community is identifiable. The leadership is very active, high quality of life, low cost of living. We go into hometowns where the population is growing, where there's essential market drivers like a university, major hospital system, Fortune 1000 companies, military, other government, tourism, something driving these markets. So we mentioned these here. You have to have some drivers that keep demography stable at a minimum, but preferably growing population. Why do we like investing in hometown? 1, there's less competition. Number 2, you can get the community on your side. Number 3, there is no new supply. You can get great cash flow because you have positive leverage. And also in a hometown, oftentimes you can buy multiple assets in the market and really almost monopolize these markets. We do something different than anyone else in the country. We source local investors, particularly in the enclosed mall space, where we get local business leaders to be part of our equity because they help with entitlements. They help with incentives, property taxes. They're effectively deputized leasing agents for alternative uses because they're on the board of the community hospital, the community college, the economic development district. So we get great guidance on opportunities or threats that we normally would not get. It reduces risk. It improves returns. How do we invest? So first of all, we got to buy property well below replacement cost. We look at tenant occupancy cost, which is basically their occupancy cost divided by their sales. We want to be in a mall, we want to be 11% and below. In an open air center, we want to be somewhere between 4 and 8%. And then we also are cash flows. We buy cash flow day one. We have positive leverage. Whether it's a grocery anchored center, we're buying at a 9 cap, or an enclosed mall, we're buying at a 13, 15, or 17 cap. How do we add value? We're really good at expense control. We've got in-house leasing, so we're vertically integrated. We've got about 100 employees, people who've come to us from Blackstone and Brookfield and CBL and the major REITs. We do renovate, so we do redevelopment. We reposition assets. We have 14 malls we own right now. We're demalling 6 of them. And so we've got the ability to do all of this in-house. Why Rockstep? Before I started this company 28 years ago, I ran the operations for a family-held chain started by my grandfather there in that picture in 1924 in Houston. We had 159 stores. So I grew up in retailing. I ran the operations. I ran the stores. I ran real estate, systems, logistics, finance, HR. I understand store metrics. I understand planograms, inventory control. I understand why retailers are successful and why they're not. And it's in my DNA. Track record. We've built or acquired close to 10 million square feet of shopping centers. We currently have properties in 11 states, 23 properties. Our returns since inception, since 1997, over a 30 IRR and a 2.1 times multiple. We have never lost an asset to a lender. We've never had a capital call post-closing. In the mall space, everybody out there has lost dozens, Simon and Westfield and Brookfield and CBL and Preet have lost dozens of malls back to their lenders. What's our secret sauce? We have local investors. We get local lenders as well. And oftentimes our local investors are on the board of our local lenders. So we get community bank lending, which is very, very flexible. If interest rates go down, we don't underwrite that they do. It is a phone call to our lender to have them reduce interest rates and send us an amendment to our current loan. We underwrite very conservatively. And then we also are really good at what we call mastering consent. So in a mall, you have to get permission from key stakeholders, whether it's Dillard's or Macy's or Kohl's or Best Buy. And you have to get their consent to shrink retail, to change driveways, to demall, whatever. And we're really good. We have a great relationship with all the key retailers. So mastering consents is another way to create value. What makes us different? We understand hometowns. We love hometowns. For those of you who have been to hometowns or from hometowns, you know there's a difference between a hometown and a New York City or a Dallas or Atlanta or Chicago or LA. Number two, we're fanatical about due diligence. We work really hard, and our brokers, when we buy a property, will tell us that we understand the asset better than anybody else. Less chance of a retrade. Number three, the rules of behavior at our company. We have 25 Rocksteps that I wrote. These are to the mat, emotional rules of behavior that we require everybody at Rockstep to live by. I wrote these rules. If somebody comes to our company, what are your favorite three rules and Rocksteps and why? What are your three most challenging Rocksteps and why? And that's the first part of the conversation. To come to Rockstep, you better be good at leasing or property management or construct, whatever it is. To stay at Rockstep, you got to live by those Rocksteps. A little bit about myself. Been in the retail and shopping center business for over 40 years. Tommy Stewart, Chief Operating Officer, been here 18 years. Dmitry Lamichev came from a Blackstone company. He's our CIO. Karen Broen, our controller, came from a Brookfield company. Case studies, Uptown Rapid. So in this one, we bought a center at a 25 cap for $12 million. This is an arbitrage strategy. We have 7 local investors in that market, business leaders, a great group of leaders. And we sold off the restaurants in front and an adjacent center for $16 million, returned all of our capital and more to our investors. Zero basis. We're left with the mall. The mall throws off $2.5 million a year. And again, zero basis. We just sent $5 million to our investors last week when we did a refi, and just great opportunity for us. This will be a 35 to 45% IRR and a 3x on the multiple. Manhattan Town Center. We bought this from one of the largest pension companies in the United States. K-State University is here. We bought it at a 17 cap, projected $2 million of NOI flat for 5 years. We're at 2.5 million. We are returning 20% of equity per year after the 8th pref without a refi because of all of the cash coming in on this deal. Lake Charles, Louisiana. This is a deal, a grocery-anchored center in a market I know very well. Our family had our first store in Louisiana in this market. We're buying a grocery-anchored center that was destroyed in Hurricane Laura, completely destroyed, rebuilt for $33 million. That doesn't include land and site work. We're paying $19.2 million for this, so half price or a little less than half price. New roof, new HVAC, new interior, new facade in a market that is about to bust because of new employment. So one company just announced 7 weeks ago the largest investment in the state of Louisiana, $17.5 billion for an LNG terminal, 7,000 workers per year for 4 years. There's 3 other expansions of LNG terminals. This is a market of 100,000 people. It's going to go through a jobs boom. Our fund, Hometown America Fund 1, minimum investment $100,000, 5 to 7 shopping centers. We're targeting an 18 IRR. We do have a promotion for investors from PassivePockets. If they invest in this fund, we will allow a 2 jump up in class. So Class A investor gets an 8 pref 70-30 split. For new investors from PassivePockets, to welcome them into our fund, we will give them a 9 pref with an 80-20 split. That's it. If there's any questions, I'd be glad to answer them.
First of all, thank you for the overview of Rockstep Capital and the track record, as well as the Hometown America Fund 1. Very impressive, and appreciate the conciseness of the presentation there. So you mentioned during the full webinar that you actually like when a tenant vacates a property because you can bring in companies that you have a relationship with who are expanding into secondary and tertiary markets as part of their growth strategy. With that in mind, how do you look at the weighted average lease terms of the overall portfolio that you're acquiring and the creditworthiness of the tenants that you take on?
Today, Paul, is different than it was 3 years ago. 3 years ago, you had a challenge in underwriting. You had exposure. Would a tenant go from $10 to $11 at the end of their option period, or would they jump across the street to an empty space and you would have to give them a $9 rent to keep them there? You had a challenge in underwriting. Today, because everybody's filling up existing product and there's no new product, you have leverage. Do you want somebody to leave? Yes, actually. Okay. Because there are 3, let's say somebody's going to pay $11 in their option. There's 3 or 4 quality tenants behind them that will pay $15 to $18 a foot with the same, if not better, credit quality. You really would like a major space to not have term, or at the end of the term. That is a true bump up, and so, would we love pennies to close in our malls? We try to buy them out. I mean, we want them to close. If they call us and say, I'm closing the store, we do a happy dance. Okay. Again, different than it was 4, 5, 6 years ago, where, retail's come into fashion because of the things I said. Retailers who survived are they have a great balance sheet, and they're telling Wall Street, we got to open up 125 stores. And a lot of them are opening up dozens, if not over 100 stores, but there's no new product.
It's really interesting, especially with the big box stores being vacated and that being advantageous to your strategy. Pascal, looks like you have a question. Let's jump to you.
Yeah, no, I wanted to piggyback off that one. I thought that was great. One of the things I noted down as I was looking through your deck, which I thought was very informational, and I wanted to give you credit and a thumbs up. I think that goes a long way. At first, I had confusion because every time I've been looking at the space, I've been interested in getting in it, that everyone tries to sell out of their fund before the leases turn. You're saying the exact opposite strategy is you want the leases to come up during your turn. And so what I'd love to kind of just understand is the whole market shifting, or is that a unique approach that you guys take?
It's a combination of the two, Pascal. Okay, so we would like to be able to replace tenants at low rent with quality tenants at higher rent, and then get them on a long term and then sell it because a buyer likes to see long term. And again, the market for bigger boxes is $15 to $17 a foot. We've got tenants in our Lake Charles Center that are at 8, okay, or 10. And so I'd love to get them with some new players, but they've got rolling options. They're never leaving. So we don't underwrite that we're going to be able to replace tenants and have a jump up. We just do base case. When we underwrite, everything bad's going to happen and nothing good. That's how we underwrite. Okay. And when we do what we call base case underwriting, and we still can get a mid-teens IRR, that means it's a very attractive type of deal, because usually you can improve your property taxes. You can replace tenants, not in Lake Charles, but particularly in malls. You can reduce retail. I mean, we're doing a hockey arena where there's going to be multifamily and hospitality. So there's all these different things you can do, particularly in the mall space. Mall space is, you're buying them at 15 cap and 20% cash on cash returns with lots of options, lots of different things that can happen.
Adam, you're new to the show. Let's get you on the scoreboard, man. What kind of questions do you have?
Thank you, Paul. Appreciate that. Thank you for the presentation, Andy. It was well done, very well laid out. You use the term demalling throughout your presentation. Is there a certain percentage that you're trying to hit throughout this fund of demalling? Is it something that you purchase with the intent of demalling in mind?
Every asset needs to be looked at individually. So we're demalling 6 properties right now. One is led by a complete demolition of the mall, except for Dillard's and Penny's, and Target is going to open up 128,000 square foot new store, and we're going to build restaurants around it. 3 other demalls are led by Ross and TJ Maxx and Five Below. The other demall I mentioned is led by a hockey arena. We're buying a property in Texas where it's going to be a demall led by a sporting goods company, an off-pricer, and then the hospital wants 75,000 square feet of medical office space. So we get rid of the interior, face everything to the outside, put on a new facade, redo the parking lot, rebrand the shopping center. What we do is we call it the Rockstep Coalition, where we get local business leaders who wanted to buy the mall, but it was too complex. So they're now going to be our investors. We'll have a local lender. And then the city is going to give us between 8 and 10 million of equity in the deal. And they're going to subordinate the returns of their equity to our new investors getting a minimum of a 20 IRR. Once our investors get a 20 IRR, anything above that is split 50-50 that goes to our investors and goes to return the city's investment. In that way, we protect our investors with a very high likelihood that prior to our second close, we'll be able to hit a 20 IRR. So that's a very complex strategy at that property. There's lots of opportunities in the mall space. Costco wants to come into some of the malls we're looking at. Major grocers want to come in. You've got to demolish a third of the center, and then you got to get consents. I mentioned consents. Very complex, but it's done from a community perspective. Our mission, Adam, is to make hometowns better by bringing capital and expertise to assets that actually affect quality of life. And if a mall goes dark, it does affect that community because, you know, how do they attract doctors? How do they attract professionals when you look at a kind of one of the best pieces of property and it's ugly? It's all about alignment. I think we're very careful in what we do. We love what we do. We love hometowns. I mean, I don't know if you guys know a lot about hometowns or from hometowns. It's a different world and it's a wonderful world. And that's where we operate.
Hone in on the fund a little bit more, but before we do, just a question on the potential macro situation. You know, the economy's remained really strong over the last couple of years, and retail has been somewhat surprisingly resilient. But recently, there's some data that's suggesting that job growth is slowing, wages are stagnating maybe a little bit where they had been growing over the last few years, credit card balances are ballooning, et cetera, et cetera. So probably lose more money planning for a recession than you do from the actual recession. But with these developments in mind, how does that potentially impact your business plan and the expansion plans of the retailers that you're working with?
So let me answer that in a couple ways. So expansion plans, first of all, no one knows, Paul. Okay, no one knows. My guess is they're expanding at full steam now. A few of them might slow down a little bit. You couple this also with my belief, well, and you're right, the consumer is under stress. Tariff impacts are not good. Interest rates are not going down. And so we are all operating in a world that is more challenging. This is where we are. Now, there is something about hometowns that are different from the gateway and the primary markets, and that is they're more steady. They really are. They don't boom, but they don't bust. And so I like our geography going through tough times. Again, I love boring. I mean, I'm not saying hometowns are boring, but our business is boring cash flow. That's what we do in markets that are not sexy. We're not into sexy, we're not into sex, and we're not into boring. So that's where we are. Now, I'm not saying, no, we are not into sex. I won't comment on anything else beyond that.
I would love to ask here. So, this entire business and strategy is all based on your ability to basically refill all of the units at a higher rate.
That's not true, by the way, but you asked the question and then we'll go back to your assumption. Okay.
Okay. Given the turnover in the fund
over the duration that you hold it. One of the assumptions I am making is that really what we're investing in here is your ability to quickly add in new tenants at a higher price point. So with that in mind, I'm imagining it's all very dependent on how much the economy is growing. I would love to just maybe better understand how you form or develop those relationships to fill them.
Yeah, so lots of questions here. Let me see if I remember them all, Pascal. So the first one is tenant relationships. I will tell you that our relationships, whether it's me and our leasing directors with the top 30 majors, there's about 30 of them, and the next 50 specialty guys is really good. I mean, I know the leads at Macy's and Kohl's and Dillard's, and we're straight shooters. We have really good people who follow these rock steps, and I will tell you that our relationships are very good with the TJs of the world and the Rosses and the Burlington. So that's how we assess where they're at, and that's how we assess deal by deal whether they could come in or whether they're threatening to leave. I mean, either way, you've got to do both. When you buy a mall and you're buying it at a 15 cap that's 30% vacant, you don't have to do a thing. All of your vacancy is upside. You own your vacancy for free, which means that you could provide wildly cheap occupancy costs to people, and it's accretive to value. And every deal you do for a new tenant, whether it's in an open air center or an enclosed mall, you have to do a very strict numerator but divided by denominator calculation. What is the additional revenue coming in from new tenant? Okay. What is the total cost of getting new tenant in as a denominator? Tenant improvement dollars, all your soft costs, and that percentage needs to be accretive to value. If the shopping centers, if the mall's worth 15 cap, you don't want to do a 12 cap deal, a 12% return deal. That's dilutive. You want to do a 17 or a 30. In a grocery anchor deal at a 9 cap, you want to be generally above 12 or 13 to produce accretive value. So you've got to have very strict return on investment criteria. Now, you asked a lot of questions. Did I get them, Pascal?
Yeah, I think you nail it. Thank you.
Can I dive a little bit deeper into that one? I know you mentioned, and I live in a hometown for...
Where do you live, Adam?
Winter Haven, Florida, so between Tampa and Orlando. So Polk County, one of the fastest growing counties in all of the U.S., kind of former orange groves, but now no longer. One of the things that I pride myself on is being able to tie to local investors, tied to local city government, find those people. They're invaluable to success. Can you dig in a little bit there on when and how you find those local board members, et cetera, that help you influence making the hometowns better?
Yeah. So Adam, the process is, I've gotten better at it, but generally is if I don't know anybody in the market, and sometimes you do. So if you know somebody, they'll introduce you to the business leaders. If you don't, you've got a network. With economic development, you meet all the bank presidents. Who are the business leaders that are active in the arts districts, who do club deals, who are very active in terms of supporting nonprofits in the market? And let's say you get a list of 10 of them and you reach out to them and you say, hey, I'd like to come meet you. I want to learn more about Lake Charles. I want you to tell me what you think about that shopping center, that location. How do you feel about the economy? You got hit by a hurricane in 2020. Are you 10 excited or 1 terrified? Where are you in this? And so you'll go and we will get just from that conversation, forget about investing, you'll get better feedback than anyone else trying to buy the property. And if you do that 7 to 10 times in a market, you understand the nuance of that market and you understand the nuance of that asset. And then many of them say, hey, I like to do invested deals. You're showing me a 13, 14, 16% return. Count me in. And then once they're in on a deal, there's tremendous wealth in hometowns. And they want to invest locally. They want to invest institutionally and locally. So they can get an institutional deal in their market with somebody who's got that expertise to be able to deliver on the type of returns that we target. It's not necessarily a smooth process. You got to get your hands dirty. You got to go in. You got to be gritty. It'd be perfect. And this happens sometimes. Hey, let me go ahead and bring some people in for lunch for an hour. We'll do an intro about who we are, what we do, what we like about this market, what we don't like about this market. What do you think about that asset? If you're interested in investing, here's the good and the bad, a track record, et cetera, and all that stuff. Then we go from there. And what's interesting, Adam, and you know this, people in small towns, some of them might not be wildly went to Harvard or whatever, but they're smarter than all of us combined. And there is a difference, Adam, in a hometown. I mean, there is. They're fun. People care. Now, I'm not saying they don't care in Houston or Atlanta, but it's just different.
I appreciate that response. That's exactly. I mean, I grew up in Spring, north of Houston. So
Spring was my first shopping center deal with Walmart. Yeah. Louetta and I-45, you know where that is?
Absolutely. Yeah.
Okay. So you grew up in Houston?
I did.
Ask your parents if they remember Weiner's stores.
I will do that.
Okay. Store 52 was in Spring.
Love the hometown connection.
Yeah.
Andy, I don't know if this was discussed in the webinar or not, but I'm curious on a typical deal and what the capital stack looks like. What kind of terms are the senior lender? What are they offering? And, are there major differences between different deals, or are they pretty much plain vanilla across the board?
Yeah. So let's talk about capital stack, Paul, as it relates to open air versus enclosed malls. So enclosed malls in a hometown, the community bank, there's a community bank network. They will be one of the lenders, or they'll put a participation together at usually 50% of cost, 50% LTV. So $40 million deal, $20 million of debt, and it's usually fixed for 5 years, 25-year amortization, no prepayment penalty, 7%, 7.5% is where the market's at today. So if you're buying an asset at 14 cap and you're borrowing, you can kind of see the cash flow. Okay.
Are you guaranteeing the debt? Is that recourse debt?
Non-recourse. Well, look, I've taken recourse. The joke is, Paul, explain to me what is recourse again? Okay. So generally, if you get a community bank, and even though the mall word used to be more of a dirty word than it is today, but you think about a lender, if debt service is $1 million a year, the NOI on these properties might be 3x, not 1.25x. Lenders want a minimum of 1.25 debt service coverage, but with a mall, you're at 3x. And if you put enough equity in front of it to get a 3x debt service coverage, most of the time you'll get non-recourse. Now, in the open air space, you have the ability to go up to 60, 65% typically, generally non-recourse. And one of the advantages of community bank lending is that besides no prepayment, which is nice, is that there's good news money available. So CMBS, there's no good news money available. Insurance company, no good news money available. So if TJ's comes in and says, hey, I want to open up a 20,000 square foot store. I need $2 million for my work letter and soft costs. You simply go to the lender and say, okay, our loan is at 14 million. We want 2 million more. Here's an executed lease. Your debt service coverage, because of the revenues, is going to go higher and your credit quality is higher. The response is, Andy, we'll take it to committee in 2 weeks. And it's always a yes. Again, we have never had a capital call after the closing in our 28-year history. And it's because of that type of lending structure. Did I answer your question, Paul?
You did. Is there a target ratio, not necessarily on an asset basis, but more on a overall fund dollar amount basis, dividing up between malls, power centers, and neighborhood centers?
Yeah, so I would tell you that our target is about 2/3 malls and about 1/3 other. Okay, I'm going to call them open air. And malls are a higher yield, more opportunistic. Open air is more safe, but also lower returns. And so that's how we're targeting this high teens IRR. And all of them have cash flow day one. And our investments, between the 8 pref current and the excess cash flow, we're targeting 35 to 50% minimum of the return coming from cash flow. A lot of investments are back end loaded. The nice thing about retail, because it's the yield sector, is that you get cash during the life of the asset.
I had one more question for you on the Lake Charles. I know you're either currently raising or you're going to purchase that grocery anchored facility. I noticed on the website that the IRR for that was a little bit lower than your target IRR for the fund overall. I think it was 18% for the fund and maybe 12% for the grocery led. Is that due to the stability of the asset that you're willing to take on a lower IRR because of the consistent cash flow? Is there something tied to grocery that you're okay with taking lower IRR?
Yeah. So again, base case underwriting is the 12. We did get the price reduced by $1 million, and we went hard last week. Just by the reduction will be between 13 and 14. We assumed that we had to replace Office Depot, and we underwrote $1 million of capital to replace them. If they don't get replaced, then the IRR goes up another 150 basis points. But our thinking was that when we put this deal under contract, the chaos from the tariff conversations were scary. I mean, this was 3-4 months ago, and we heard from our investors that let's play it safe, at least on this type of deal. And, I know this market. I've been there 50, 75 times. And what's also interesting about Lake Charles is my wife was general counsel of the firm that sold to Woodside that announced the largest investment in the history of the state. And so I've been living what was a final investment decision, FID, 7 weeks ago, 5 miles from the property. And so I've been living Lake Charles. I know Lake Charles. And then to get an asset that has a new roof, I salivate. It's unbelievable to get a new roof, a new HVAC, and new interior. It doesn't happen really, guys. And so I felt safety-wise, knowledge-wise, timing both from the turmoil and the fact that there's a jobs boom in a market of which I knew personally a lot about. I said, God, it sounds good. And our team was excited as well because, again, 3-4 months ago, with all this news from the tariffs, we're all trying to figure out how to not mess up. And we're all in the same business of not messing up.
I've got a kind of maybe a final question for you, Andy. Usually when something has a high cap rate, that means that there's less people bidding on it, less interest, likely due to the risk. I'm just wondering, why is the cap rate, so high? It makes me wonder, what's the risk?
First of all, it's a great question. So it's high because it's perceived risk. Okay. So I've been interviewed multiple times in the Wall Street, and I tell the writer, keep the bad news coming. You don't want to buy. You don't want people to show up. So when we go and we buy, we're competing against 3 or 5 or 7 people, not 50 or 200 people. But it's perceived as risky for 2 reasons. First, there is a belief that NOI is not stable, okay, and that it's going to fall. So the key underwriting we do is that we have all this experience. We own 14 malls. We've sold some as well. We have experience really estimating the sustainability of NOI. So the broker says it's at X. We'll do a tenant by tenant analysis. We'll write it down. It's really going to be at 84% of X. And our confidence level needs to be 95% that we can sustain NOI. All you have to do is sustain it. At a 15 cap, you sustain it. You don't have to improve it. Now, we're able to improve it at times, but you want to sustain it. So one is a perception that NOI is a falling knife. So you've got to sort through the opportunities to determine where is NOI, where can you believe that you can sustain NOI. Number 2, debt is hard. That's hard. The word mall scares most lenders. There's debt funds who will do it, but the debt funds are 10, 11, 12% with points in a very short duration. So our strategy is go local. Just make it a community effort. Get local investors. Local investors are on the board of community bank lenders, and community banks want to invest in their community. And they see the debt service coverage. They see their board members and community leaders who are part of the game. And that's how it's done.
I've got one more closing question as well, and then Adam will turn it over to you. I want to make sure I understand the fees. There was a 1.5% acquisition fee and a 0.75% disposition fee. But then if you get into the PPM, it says, or a greater of the minimum or greater of 200,000 or 1.5% or greater than 100,000 or 0.75%. So, on a smaller asset, what that means if you do the math is that if the asset is less than 13 million and change, the stated fees of 1.5 and 0.75 respectively are actually not that. They're much greater on a percentage basis for that asset. So like if you buy like a neighborhood retail strip center that's $2-3 million and you charge a $200,000 acquisition fee on it, Paul, we have the right to do it. Okay.
Number two, we've got to be good fiduciaries. I mean, if it doesn't make sense, it doesn't make sense. Number three, will there be anything in here under 13 million? I don't know. Probably not. And the reason is that it's just so much work for a small asset versus a bigger asset. Our target price point is 20 to 75 million. Do we look at stuff that's under 10 million? I don't remember anything we've looked at in the but we could. We have had situations where we spent a year or two doing a disposition, separating a parcel, doing all this kind of work and creating massive value, but not getting compensated for it. So we're trying to balance, but rock step number one, do the right thing always. You have to figure out that's what investment management is about. It's a world of gray. And so you have to ask yourself, what is the right thing? How do you allocate this expense if you're visiting two properties? It's the same issue.
So with us as limited partners, it goes back to the conversation around trusting the sponsor, which anyone who invests with you has to do. There's just a lot of, I guess, discretion on your part as to what you charge, 4%, for example, for property management fees or market rate, quote unquote. So I guess the question is, if you're not hitting your target IRR, are you at your discretion taking lower fees so you make sure that you hit that IRR?
So let's talk about that. So we're vertically integrated. And if you compare us to, let's call it CBRE or JLL, I mean, the big national folks, our fees are at theirs, if not lower. Okay. So we have the option of saying, hey, JLL, CBRE, come in, have at it. We don't like that, not really because we don't get the fees for the work that we're going to do, and we don't, but you have conflict of interest. You avoid conflict of interest if you own the information. There is an issue about if an asset is struggling, do you lower the fees and not be able to attract the kind of talent we want? It's a tough question. Every sponsor faces it. I will tell you, we pay well. We've got 100 employees. We don't use fees as a profit center at all. But I'm also not embarrassed to say that we have the right for fees if we are going to bring the kind of people who follow the rock steps, and if we're going to try to be A+, institutional A+ in everything we do. And we're not institutional A+ in anything we do. We're trying to get better all the time. But you hit on a really good point, Paul, and there's no easy answer for it. You have to be honorable to the investment. You cannot abuse it. And it's a judgment call. Again, very, very good point. I think our fee structure is very market, in many cases below market, and we talk about it all the time.
Appreciate the transparency there. Adam, why don't you take us home?
Appreciate the honor of going last here. Andy, I read two of the case studies on a previous presentation or on your website for Uptown Hutch and St. Landry's Plaza. One of the things I noticed there with your fund is aiming for kind of a 5 to 7 year hold period on these assets. Both of those were purchased, if I'm not mistaken here, back in 2014. And on both of them, they list that, 2026 is the perceived date of sale. There's what the goal is. That's obviously let's call it 12 years for both of those assets. Could you walk us through, did something go sideways on those that forced you to hold those longer? Or was it the best of times, the worst of times? You made that decision as a group.
So Hutch was 2014, Landry's Plaza, I believe, after that. In Hutch, we were planning to exit right around COVID-ish. For the shopping center business, COVID was very hard on us. We were in default on every single loan. We had an opportunity in Hutch to do another round of development after COVID. That property started at 150 of NOI. We were at $1.3 million. We have the ability to take it to $2.6 million of NOI. And we were able to just get the city to give us a 2-cent sales tax on our property that will give us $700,000 a year of additional unbudgeted annuity incentive from the city. So we're going to put Ross in. We're going to put 3 or 4 other tenants. We're demolling it, and we're going to exit it. That asset went way beyond our target. And if the markets are weird, we're not going to be forced to sell into a negative market. And COVID really pushed everything back for us. It was very hard on our company. We had to renegotiate 575 leases in a period of 3 months, and every single loan was in default. you're not getting income, and it's measured on a quarterly basis. And so we didn't lose a property, but there were a couple of our assets were negatively affected by COVID. And we'll come out really good in Hutch, really good.
Thank you very much.
Yeah, Andy, thank you very much. This has been very insightful. We appreciate your time and your transparency here. And just thank you for coming on to the Deal Review series.
I want to add one thing is that I encourage all the Passive Pocket members to at least think about retail as a place for investments. We have a learning center on our website. Our goal is to become the country's best educator of investing in shopping centers, good and bad, good and bad. What are the terms? What are the different types of shopping centers in a tremendous detail? So anybody who really wants to become schooled in it, they can do videos, they can read articles. Some of it's, co-tenancy issues, IRRa, different types of shopping centers, different types of markets, disadvantages, advantages of this and this and this. So I encourage all the members of Passive Pockets who want to learn about retail to please come to our website at rockstep.com and then go push the Learning Center.
I know I'll be checking that out. Thank you very much for that.
Okay, Paul, thank you. Adam, Pascal, thank you guys.
All right, guys, we're at that part of the show where we get to do a deep dive into what we learned from Andy and discuss what we like about the deal, some of the things that maybe we don't like or have concerns with, and then think about how we might allocate capital, if we would allocate capital into this deal. And I want to make sure the listeners know that, again, we aren't here to make any recommendations. We're here to provide additional insights into the opportunity. If you're considering investing, we strongly recommend that you make your own conclusions and do your own research. All right, Adam, as the newcomer, you killed it today. Thank you. That was awesome. Great questions you asked. I'm going to ask you first, what red flags, if any, did you see on this deal?
Yeah, thank you, Paul. So I think the red flag that we may have commonly across us is retail. Kind of being in the digital age that we're all in. I don't go to a retail center to make purchases. I purchase on Amazon and online. And even for those, the Best Buys and the Kohl's, they have very strong digital presence. And I'll admit, I came in with more of a negative view set on this than I think I would have now because of that. On this particular deal at this point in time, I don't have any other red flags. There weren't things that Andy mentioned that scared me away. I feel like we got at him from a couple of different angles here on his underwriting, his rationale for holding beyond the normal time, taking on assets that have lower IRR because, they have a better, stronger, more conservative base with the grocery panels. But nothing that comes out from the top other than me getting beyond that it's retail. And do I want to invest in a mall? Right. That to me is the red flag that I think if I had the opportunity to sit down with his team for a couple of hours, see the underwriting and really dig into what happens if another COVID happens, that would probably get me past that internalized fear that I have on retail.
I think it is interesting. You mentioned COVID. I try to remind myself about recency bias that if you look at the amount of times a COVID has happened in our lifetime, it doesn't happen very frequently. I side more on okay, how is retail going to play out as we become more digital? I think in general, there's still going to be some sort of need for these. And I like that there's not an increasing supply. I think that's what maybe attracts me to this. I haven't invested in this space yet, but I'm increasingly more and more interested. I love that they are primarily cash flow plays. You were talking about a little bit of red flags. The thing that really caught me is that I usually come across operators that are trying to take something that has 15 years of lease terms, average lease term. They're going to get into it and then sell it before, leaving 5 years left or something on the clock. And I think it was very opposite of most deals I've seen in this space. And I actually love that about this team. I think to get really comfortable with it, I think as I kind of asked him, you basically just have to believe that this guy knows how to really fill these units. And if retail becomes less exciting or, the demand for retail space drops or, we have massive inflation and people do less out, I think you have to believe that he's able to do that. And I loved his answer. I would probably in my process just really dig into that because I think that is the core of what you're investing in here.
Yeah, you guys make some really good points. I think you can liken this strategy, if you were to compare it to multifamily, to like a heavy value add or a deep value add type of deal where there's a lot of upside. In this case, more so probably operationally, although they may be doing some construction, tenant improvements, et cetera. He said he had to rip off like a third of a mall at one point to reconstruct and put the plans in place for the new tenants. So there is some of that, but this is definitely not buying a coupon, which you do see a lot in this space. I kind of like, I'm more familiar with the neighborhood retail strategy where you've got, smaller bays, or square footage, I should say, maybe 8 to 10 tenants in a strip mall. And you can kind of get around a strategy there where maybe to your point, Adam, it's e-commerce resistant, it's recession resistant, because these tenants are the dentist's office, the liquor store, the pizza shop, the hair cutting place, the nail salon. Those businesses aren't going to be replaced by Amazon or really struggle if the economy's up, the economy's down. They're still going to do well, in their businesses. But a Kohl's or a TJ Maxx or some of the other names that he mentioned, you can see risks from kind of every angle when it comes to the economy struggling or people buying more from Amazon. So I tend to agree there. He made a point too that hometowns are boring and they're steady and he likes the geographies that they're in. I tend to agree there, but what's also true is that a lot of these hometowns are dependent on one or two major employers. So there's a risk there of the local economy struggling if one of those employers has issues, a lot of layoffs, or just their business in general is subjected to the risks of what we talked about prior, or AI, or any of these things. So those are things that I would watch out for, but these are just broader kind of concerns from a macro or a thesis standpoint. As far as red flags in the deal, I didn't see anything that really stood out. I mean, we obviously have a time constraint here, so we didn't get to ask, I'm sure, all the questions that you guys had. I know I had a few that were left. The fees were one that was a little bit concerning to me because it was, as he stated, sort of at their discretion as to whether or not they do what they say they can do in the PPM. And if they can charge what they said they can do in the PPM, there's quite a bit of fees there. There's layers and layers, construction management, project management, loan guarantor fees. There was a fee just for processing the loan, which is, that's done by the lender, not the syndicator. So I'm not sure how much of these can add up to and what that would take away from returns. There was also another question that I had in there about after dissolution of the company, they can recall distributions from LPs for up to 3 years. That was on page 10 and 11 of the PPM. I don't know why they would need to do that and what circumstance there would be that they would have to call us back up and say, hey, sorry, we paid you guys out. We shouldn't have, but we need our money back after the business is wound up. But, maybe there's an explanation for that and it's not a red flag at all. But overall, I was impressed with obviously the track record and Andy coming up in the business too. I think that's a leg up on a lot of others that may not understand, being in the shoes of the actual retailers themselves. So I really like that piece. And I'm sure, they have operational capabilities with 100 plus employees. Let's talk about the opposite end of the spectrum. Adam, what was your favorite part of the deal?
I think in general, how intertwined he is within retail. So when he goes into his secret sauce, and honestly, while I appreciated the answer of why is the cap rate as high as it is, the market perceives risk there. What does he know that we don't? Right. That if he's seeing something that we aren't, I wanted to dig in on that. But overall, the ability to master consents and to dive into these local towns and go try and find city government workers, go find the people that are on the board of directors, meet the local lenders. I don't want to discount either the fact that that's extremely difficult to do. I've lived in this town for 5, 6, 7 years. And it's taken me all of that to get to know those people, to get to know those lenders, to get those lenders to trust me as an outsider. So I don't want to discount the fact that he can't do it. I think it would be very difficult to do, but he's confident in the way that he portrays that they have the ability to do it. They can make these relationships quick because they're respected in the market. That to me was a very strong signal that he gets this. He lives it. He breathes it. It's been his dad's full life, his full life. I think he's one of those people that, I forget who says it, Warren Buffett or whatever, build a really big basket and just keep staring at the basket, right? Like, I think that's where we're betting on the jockey and not the horse in this instance, because I think all of us feel that fear of retail. But I was impressed on that front just because of his knowledge there. And as long as there's not key personnel risk of Andy being that one person that everybody at Dillard's and Macy's and everything else could pick up, I would say that's a really positive in my mind.
Pascal, how about you?
I think you learn a lot about an operator by their investment deck and how much they put forward, how much they make transparent. And if you look at this deck, it has pretty much everything that you'd want. Existing portfolio, full cycle deals, what the P&L looks like on all these different properties. That says a lot. I love that. I think as I look at the track record, something that I think is pretty interesting is, one, they've had a lot of deals go full cycle. If you look at it though, this is maybe more of a, flag, it's a plus and a something that I'm just looking into, is that if you look at the deals they did, they're all very early, like in the 2008 to, 2015 cycle. And the returns there are massive. He also did different types of deals. He did like development. And so if you look at the neighborhood centers that he has, those, at least more recently, they haven't produced these massive returns. And so I like that he's transparent. I love that it's here. Would love to dive into that more. And also, I think something that's just like I would look into deeper for the listeners is digging into, okay, we can't look at the retail development track record because that's not the type of deal we're doing here. Like, let's look at all the deals that are an enclosed mall or a neighborhood center and compare those, especially most recently, instead of just like, making money from 2009 to 2015.
Yeah, that's a great point, Pascal, and something definitely worth digging into. I won't repeat, Adam, what you said about the positives of the deal. It's pretty much the same sentiment I have. One of the questions that I had is, do you guys know whether or not this is their first fund?
I don't know. It is America Fund 1. So we got that on our side, but I don't know if he's done any other funds.
That's a clue, a good guess that maybe it is. So just kind of digging into that as well and trying to figure out the mindset behind why switching now to a fund. I know that they're involved in a number of different capital raising tactics, I would call. I know their investor relations person, their name is kind of a big name in the space as a capital raiser, and now they've brought them in-house. I saw one specific deal. It was that Lake Charles grocery anchored retail deal put out on a list that I'm on. It looked like it was a single asset deal, not part of a fund. So I'm not sure if they're raising money concurrently and how that looks. But, obviously they're getting into different pockets. Just being on this show is an example of how, they're trying to broaden their network and get new capital to come in-house. So that's a question I would have. Do you guys have any additional questions that you would have asked if we had more time?
I have a strategy, which I think is very LP-centric, not very GP-centric. But for the LPs out there, I think something that a strategy that many family offices and even major institutions like we did when I worked at Techstars, this is a fund, and I would love to understand how much of the fund has been raised. Are we first 10%, 20% in, or is it like, we've got 500K left and we're trying to fill that? It is in the LP's benefit to wait as long as possible and to invest at the very last moment possible in the fund, because then you can see all the assets that are already in the fund, how they're performing and the exposure you have. The only caveat is that then, one, you may miss out on the deal, or two, the terms. I don't know if the terms can really change, but at least the benefit of allowing people in at Class C instead of Class A could be a differentiator.
I'd like to dig in more and kind of ask him more about the NOI and his sensitivity analysis there, just to kind of go back at my hypothesis that I'm not a real believer in brick and mortar retail. What does that sensitivity look like? Because Pascal, like you said, right, going forward, his IRRs are significantly lower than his 30+% returns in the past, because these are different assets. These are different heavy value add build outs. I would love to see that and see where we sit on that sensitivity table and how sensitive it is, not only just to interest rates, but truly to movement within that NOI. If we were to have AI come in and say, now if you're buying your clothes from Kohl's, you can hold up your phone and it can project those clothes on you, right? So you may not have to go into Kohl's and make those purchases. I think that goes back to kind of an earlier point of mine of wanting to dig into the underwriting, because I think that NOI number seems to drive a lot of what he wants to push forward in this fund of cash flow.
I mean, I think the thread that you're pulling on, just to like make it more concrete, is you're thinking about how is this space going to change over the next 5 years or 10 years? And to me, there are two major things that are going to happen, or maybe three. One is autonomous vehicles. Is that in our reality in the next 5 years? They're already launching that in Austin. Like, does that mean people move out further than the neighborhood? Is that relevant? Maybe if it's autonomous, people are still going to come. The second one is robotics. How much is robotics going to change I think that's something that's the big question in my mind, but I think that's going to be a huge trend in the next 5 or 10 years. And then I think third is with this AI wave, how much does layoffs or, maybe these neighborhood areas are a little bit sheltered in because maybe the AI is going for like white collar instead of the blue collar. I think, but those are the three major trends that I think I'm thinking about when I think about this asset class.
Speculation. I love it. All right. So we're at that time now, guys, where you have to pony up here and decide whether or not you'd allocate. If you had capital to deploy, Adam, let's start with you. Would you invest in this deal?
If I had capital to deploy in this one, I'm very close to the maybe. I know we're not allowed to. I don't think I would. I take my investments in 10-year chunks. And if I look at this on a 10-year term, do I think it will be strong in 10 years? I don't. I don't think there's anything wrong with the fund. I think it's well played. I think it's great people who run it. I know we have questions, but I don't think any of those questions frighten me as red flags. I just don't think it would be one of those areas that I'd like to kind of add into my broader portfolio, even though I have nothing in retail today. I think just fundamentally inside me, and I'm interested to see more of these learnings and things that he's publishing online because I can be changed. Today, I'll take it as a no, but I do want to learn more. And this was a fascinating conversation. And the research I've done on this, I would have never done without this podcast. So I'm very interested to learn more, but I'll lean no today, Paul.
All right. Pascal, what about you?
I'm leaning closer on the yes side. I want to understand the consistency of the cash flow. I think this could be an interesting cash flow position for me. I think if you're an equity investor, like maybe this is not, he focused on cash flow. That's what I'm very interested in. So I think that is something. I think if you buy into his expertise, that he is the person that is, able to fill these units. And I think also on like a 10-year time horizon, the world is changing and I could be wrong. But one of the big things that was on my mind was he kept saying it's a 4% average rent growth rate in the deck. And I went to go do some research. I was like, that seems high to me. And it's like, that's pretty average across the US, and it's growing every year and it's been really stable. And we've had the internet and we've had, and so, yeah, I think I'm closer to a yes for this one.
All right. I guess I'm the decider here with the split vote. I wish there was one more person on this panel so I could think a little bit longer about what my answer would be, but I guess it's my turn. I can see the thesis. I see Andy and his team having the track record to pull something like this off. I think that there are better risk-adjusted bets you can make to get the cash flow that you're after, Pascal. So I think you're kind of stepping out on the risk spectrum a little bit, and maybe that risk-adjusted return isn't in balance. If there's more upside there, like an 18 IRR that's good. I mean, it's not bad, but for this type of deal, I think maybe there should be a higher return. Now, to speak out of both sides of my mouth, if they advertise a 30 IRR, I'm probably, coming down on them for that, because there's no way in the world, you advertise that and get away with it. But I really do have concerns just around the malls. I wish that more of the portfolio was going to be allocating into the neighborhood retail centers and maybe even the power centers versus the malls. I feel like the malls are sort of a dying breed. We all know, even in affluent towns, there's malls that are sitting vacant and not being visited, and all the e-commerce and the things we've already touched on are there. So it's really predicated on them repurposing these stores, I feel like, into something more useful for the community. And I know that's their goal, and maybe that's just bringing in another retailer, but maybe it's something else. I'm just not there yet. I think if I were going to invest in this, I would take Pascal's advice and wait till there was more assets in the fund so I could kind of see what they've collected, underwriting each deal sort of individually. Right now, it's just send a check and then see what they go after and shop for. No pun intended, but that to me is a little bit uncomfortable in this asset class. So I'd probably pass today, but nothing against Andy or his team, his track record, and kind of their thesis just being a little bit different. I think that's cool. And it could be, for the right investor, a great opportunity. So there you have it. Pascal, Adam, thanks for all your insights and your participation on today's deal review. That wraps us up.
Yeah, thanks for having us on.
Thank you for having us.
And that's a wrap on this deal review episode. A big thank you to Andy Weiner from Rockstep Capital for walking us through their Hometown America Fund 1, and to Adam Cranmer and Pascal Wagner for joining me on the LP panel. We hope this gave you some useful insights into how limited partners evaluate private real estate funds and what kinds of questions you should be asking before making any investment. Thanks for listening, and as always, happy investing.